Hello, folks. What if I told you it was possible to read the mind of the stock market and predict future prices of stocks? Today, we'll use Google Trends to read market psychology and apply Charlie Munger's powerful contrary idea to invert, always invert, in order to make money in consumer stocks in 2026. Here are the details. All right. So first of all, here we have this chart that shows the Mag 7 large technology stocks in blue, S&P in orange, and a basket of consumer stocks in green from 2023 through 2025. Okay. And notice the huge performance in these Mag 7 type stocks in each of these 3 years, but all three baskets of stocks categories have been going down. Notice that in 2023, the consumer stocks very much in this basket very much outperformed the S&P 500 and even in 2024. But in 2025, this basket of consumer discretionary stocks actually had a negative return and dramatically underperformed the S&P 500. Okay, very much uh, out of favor, so to speak, in terms of market psychology. And the stocks that are in this basket are Lululemon, Home Depot, Airbnb, Cava, Dutch Bros, Elf, and Sphere Entertainment. And I chose these types of consumer discretionary stocks because they kind of represent a basket of companies that bias a little bit more towards 20, 30, 40-year-old people, definitely not consumer stocks that bias towards elderly people. All right, so this type of investing that we're going to look at could be called information arbitrage style investing. So this type of information arbitrage exists when you have information that the market does not. All right, so it's pretty simple. The way it works is you buy a stock when you have positive information that you believe the market doesn't. You sell the stock when that information hits the market or becomes aware of the general stock market. And classic examples can be found all over the place, but particular you can think of Warren Buffett's investment in Coca-Cola in 1998, where the stock market was really ignoring the favorable long-term growth opportunities with Coca-Cola. Warren Buffett could see that there was tremendous growth in their international markets. And when he looked at metrics like the average number of servings of Coca-Cola products per person in the US and compared that to Mexico, Canada, Europe, the Middle East, Asia, etc., he could see that there was tremendous opportunity for Coca-Cola to grow over time, and the stock market was just ignoring this. So that was when he made that investment. 1963 made an investment in the American Express Company, which was experiencing a temporary period of depressed stock price caused by a strange little division in the company that sold traded vegetable oil. And there was a scandal with the person that was running this division where they were putting water in the tanks of vegetable oil, and there was a little fraud. And Warren Buffett read all through the annual reports on this company and went to a restaurant and noticed that people were not didn't this didn't stop people from using their American Express credit cards, and he realized that this is a temporary phenomenon and that the long-term growth prospects for American Express were perfectly fine. So Buffett always says be greedy when others are fearful and fearful when others are greedy. Munger's version of this is to invert, always invert when it comes to market psychology. Peter Lynch used this type of information arbitrage style investing when He first learned about Taco Bell. His back when in 1978, Taco Bell was kind of a smallish regional type of new restaurant concept. Most up until that point in time, fast food restaurants had been classic American type food like McDonald's hamburgers or Kentucky Fried Chicken. And so this kind of ethnic kind of cuisine idea was new. And he went to a Taco Bell with his daughter and had a bean burrito. And he said, this is really fantastic food. And this company is probably going to expand nationwide and maybe even go international. And in fact, the PepsiCo company saw this company also and noticed that it had tremendous long-term growth prospects and actually purchased Taco Bell a few years later. And Peter Lynch made a lot of money off of this investment. He talks about it in one of his books. I've used this principle that I've learned from these guys in order to make investments in a similar way. Sherwin-Williams in 1999 was being sued by the state of New Jersey for lead paint that was found in apartments back in the 1920s. 1920s and 30s is when this paint was applied. And, it's like I thought that this lawsuit was ridiculous because nobody would be able to prove whether it was Sherwin-Williams paint or, some other company's type of paint. And the stock price was very much depressed, but it's a great company that has a vertically integrated business model from manufacturing all the way through retail distribution network, excellent capital allocation strategy of dividends, share repurchases, bolt-on acquisitions, and so I made a purchase in Sherwin-Williams back in 1999, and I sold that investment about 8 or 9 years later for I made about 9 times my money off of Sherwin-Williams. Similarly, I invested in Cava in October of 2023, and I sold most of it in December of 2024 and the rest of it in January of 25. And I'm going to show you on the next page what was going on in a sense and why I made this investment. It's very similar to Peter Lynch's Taco Bell type of investment. Although, because I live in Dearborn, Michigan, and there's a lot of Mediterranean style, wonderful Mediterranean style fast food restaurants in the area, I was very familiar with the flavorful and actually, it's a very healthy type of cuisine. And so I felt that when when word came out that there was going to be an initial public offering of a Mediterranean style restaurant that was in a similar business model to Chipotle, okay, in terms of fast casual, I really took notice of this. And during the IPO, and by the way, right now we're looking at Google Trends. So to use Google Trends in order to read the psychology of the market, you have to go to, Google Trends. And for example, you can do a search like I did this search here on Cava stock price. And you can see how many people are searching for Cava stock price over time with this graph. And you can see during the IPO, there was, before the IPO, nobody was searching on it for Cava. Nobody was aware of it. And then all of a sudden with the IPO and all the publicity that the investment banks were pushing out to the large traditional media outlets like CNBC and Bloomberg, everybody was talking about it and searching, for it. And then I use Munger's advice to always invert. So I just kept a note of the fact that the IPO is not a great time to get in because that's when everybody's excited about it. And I waited until in a sense, the excitement of the IPO wore off. And about 3 or 4 months later, it had drifted from a IPO peak of around $54, $55 a share down to about $30 per share. And that was when I began to accumulate shares of Cava. And then the the interest in the company began to increase, especially when the earnings reports began to come out and people began to see that their same store restaurant sales numbers were extremely high, like over 10%, and they were expanding number of locations. And then people like Jim Cramer on CNBC began to talk about Cava, and people started to get excited in mainstream media sources about it. And I didn't use Google Trends, but you could have used Google Trends in order to see that the general trend in people searching for Cava was going up and up and up. And then we hit this peak when they had these tremendous earnings came out, and that was when Munger's advice to always invert, began to really ring home in my mind. And I saw that maybe it looked like the market was overvaluing it, because I purchased around $35 a share and it was up around $160 a share at this point, and that's unsustainable. So buy low and sell high. So I sold about half of it, and then for tax reasons, I waited a little longer in order to sell the rest of my Cava position in January. All right. So what's going on right now, which is creating an opportunity for consumer stocks? Remember, change is the thing that creates opportunity for investors. So what's going to be changing in 2026? Number one, compared to 2025, we have incumbent politicians are up for their midterm elections. We're talking senators and members of Congress. And there's a tendency of politicians to do pretty much everything in their power to stay in power. And the consumer hasn't been very happy lately, and they know that they need to, in a sense, buy votes. So you might hear politicians talking about something like a tariff dividend, like sending checks to people that are somehow based off of the tariff revenue that's coming in. That would be an example of a fiscal stimulus policy. The big beautiful spending bill is going to, from a tax standpoint, is going to take effect January 1st, okay, next week. And that it's going to have no tax on tips, expanded standard deduction, reduced taxes on overtime. Stuff like that is going to put more disposable income in people's pockets. So that's another form of fiscal stimulus. Fed Chair Jerome Powell is going to be replaced. His term is expiring in 2026, and I would imagine that uh, Powell's successor is going to be named pretty soon. And it's well known that President Trump wants lower interest rates, so we're going to have telegraphing lower interest rates into the psychology of the market, and that's monetary stimulus, makes it easier for people to borrow money. We're also just in the past couple of weeks resumed something called quantitative easing by the Fed, which means that they're going to be buying short-term treasury bills, and that is going to pump money into the banking system and making more money available for people to borrow. It's going to help lower the short-term interest rates even more. And a lot of that money that is currently sitting in like CDs and earning a 4% or 4.5% type of return is going to move into stocks, all right? Because this is also going to cause inflation to go up. So if inflation goes up and short-term interest rates go down, we're going to be, by the middle of the year, we're going to be at a point where there's going to be no real return off of putting money in bank savings or CDs. As a matter of fact, if inflation goes above, say, 3%, and short-term interest rates go down to 2.5%, then people will actually have a negative real return on their money. So that money has to go somewhere that gets a real return, and it's probably going to go into the stock market. It almost always goes in the stock market. All right. Quantitative easing does that. Tariff price increases are going to work their way through the economy, and those price increases are going to begin to slow, or I would call this a second derivative type of effect. Year-over-year comparable revenue and earnings for these consumer stocks is begin to look better by mid-2026. You know, earnings for these consumer discretionary stocks didn't look great in 2025. So we have very low comparables to compare our 2026 numbers against. So what's the investment strategy? Buy consumer stocks now while they're out of favor and hold them until the stock market kind of realizes that these effects are occurring. And I think that the holding period should be in from now until, say, in the March to August of 2026 time frame. You can see this chart is the University of Michigan Consumer Sentiment survey, and the consumer in 2025 has just been crushed, especially in the middle and lower income cohorts. So politicians know that the consumers have been pinched. So this number has got to get up in order for people to reelect the incumbents that are currently in office. Once again, my basket of consumer discretionary stocks, and what I'll do is I will periodically make updates on how this basket of stocks are doing. I've put about a little less than 10% of my portfolio into an equal weighted uh, of each of these companies recently. Actually, I did that this morning. So once again, we're talking Lululemon, Home Depot, Airbnb, Cava, Dutch Bros, Elf Beauty, and very interesting company called Sphere Entertainment. Uh, Nike could be substituted into this basket. However, I just don't know how their sales in China are going to be in 2026. That's a big mystery for me. So, is this investment strategy that is of interest to you? Will incumbent politicians use their influence to stimulate the economy in 2026? If you believe that to be the case, then this type of investment might be for you. Do you believe Wall Street professionals have been overlooking consumer stocks, especially the types of consumer stocks that I've been talking about? If so, this type of investment might be for you. You can always go to Google Trends, it's free. Here's a chart that shows Nvidia is the interest in Nvidia stock price is staying high, high, high. You can see if you compare the interest in Cava stock price over time, it's been drifting down. So it seems to be out of favor. Okay. So, um, once again, this is this is something for your consideration. You need to talk these ideas over with your financial advisor, do your own research. Think about using Google Trends in order to identify market psychology and to understand where the mind of the stock market is, and to use Charlie Munger's advice to always invert and buy low, sell high. Okay? So until next time, I'm Jeff Whitaker. Thanks and take care.